There we go. Hi, everyone. Thank you for joining us and welcome to Leveraged Insurance Strategies. This is a very important topic, even if you don't use it very often or even if you never use it, as it really demonstrates the quality of the investment strategy that we use for a lot of the whole life strategies, a lot of the other corporate strategies, really demonstrates the quality of the asset because banks are willing to lend against these assets, and that gives both you and the client a lot of optionality. When a client invests in RSPs, for example, they can either cash them in or not cash them in if they needed some capital, whether it's to pay for retirement or to help with a wedding or anything like that. With par leverage strategies, you have another option. You can borrow against it. You might even want to use it to increase your investments elsewhere or into this same strategy. And that optionality can come into play in a lot of different ways and gives the advisor as well as the client a few extra tools, whether it's in retirement or prior to retirement as they're accumulating. And I think it's a very good topic to have a strong handle on when you're talking to clients. It can be very important. This can lead to some larger case opportunities for the right type of client that is interested in utilizing leverage to either grow their investment portfolio or as part of their drawdown strategy or retirement income strategy. So with that, I'll turn it over to Michael to get started on leverage insurance strategies.
Perfect. Thanks, Corey. So I'm going to kick things off with what's called the Corporate Insured Retirement Plan, CIRP for short. And if you picture someone with a corporation, they have their whole life insurance policy owned by the corporation, corporation's the payer, corporation's the beneficiary, they're going to have their cash value. A lot of business owners are going to leverage the cash value back to the business for a variety of reasons, either business investment, business emergencies, business cash flow, essentially anything the business needs. And this can be done on a very tax efficient basis, if not tax free, depending on the ACB of the policy. That's kind of the more common approach, or more well-known approach when it comes to any business owner purchasing and investing in a whole life insurance policy. But there is a different way that they can leverage this for personal use. And what they would do instead of using the cash value as collateral for a business line of credit, they would actually use the cash value as collateral in exchange for a tax-free personal line of credit. So in this strategy, the corporation is still the owner, it's been the payer, it's been the beneficiary, but the business owner, the shareholder, is actually using this corporately owned whole life insurance policy as collateral, and in return going to a third-party lender to get a line of credit against the cash values. Now, there's a lot of important tax considerations to think about in this and to let your client know. There are guarantee fees, which I'll get into. There's certainly a tax discussion about some of the risks and the kind of the what to do's and what not to do's, and there's going to be underwriting as well. So this is not, by any means just a quick way to just get tax-free money. Like, I wouldn't necessarily phrase it like that. This is not any sort of tax evasion or anything along those lines. This is a well thought out strategy that would include the client's accountant, potentially lawyer. And this just has to be something that's done with all the check boxes kind of ticked off. So I'm going to give you some examples of through the Sun Life software of actually running an illustration to show what these kind of guarantee fees and tax considerations you'd have to think about when suggesting this or looking into this for your client. So I did an illustration with a 45-year-old $2 million policy, overfunded for 4 years, so $120,000 a year for 4 years, just to kind of show you a baseline illustration. So this has this individual starting to do the CIRP when they're at age 75. So I waited 30 years for it to basically accumulate. And you can see here they're able to utilize $81,000 per year for 15 years personally from the cash value in this policy. You can see the accumulated loan balance that's just growing with interest basically over these 15 years. And you can see the guarantee fee. Now, the guarantee fee, it's suggested to be anywhere from 1% to 2%. I'm using 2% to be conservative. Now it's also 2% of the outstanding balance. So you can see that the guarantee fee is going to increase as the loan amount increases. So I'll get into considerations on the next few slides, but generally speaking, this individual is being able to utilize $81,000 a year tax-free from their corporately owned whole life insurance policy, and then they're going to be paying back the guarantee fee to their own corporation. All I really want to look at is the total CDA credit. So if this individual lives to age 90, they have a death benefit of 2.5, a CDA credit of 2.5, but they do have an accumulated loan balance of 1.9 million. So if they passed in this scenario at age 90, 1.9 would get minus off the 2.5, leaving them with 583 net of tax-free money to the corporation after they pass. But as you know, the CDA credit is going to be the difference between this 2.5 and this 583. So just under $2 million of additional CDA credit this individual would have for further estate planning and tax planning considerations, which in other words, they have a $2 million credit to the corporation CDA that they can also now pay a tax-free capital dividend out of the corporation up to that roughly $2 million dollar limit, which if you're just assuming for simple math, a 50% tax bracket, that's an additional $1 million in taxes saved based on how much they can actually withdraw through the unused CDA credit. Now, a few positives about the strategy. So number one, as I mentioned, is going to be that CDA credit, that gap between the actual credit and the net payout. So there's going to be more tax savings in the future for your client. There hopefully would be a net life insurance payout as well, just depending on how much the accumulated loan is outstanding and the interest rate. And there's obviously going to be how much the shareholder is actually receiving as they're alive through this strategy, depending on how many years they're planning on doing this for. A couple of things to watch out for is the length of borrowing. So I did the illustration through Sun Life, so I would encourage everybody to go through the Sun Life software and play around with this. But you can see that kind of like the longer you borrow, of course, the accumulated loan balance is going to increase, the amount of interest is going to increase, and you just got to make sure it's still in the best interest of the client, mathematically speaking, to do the strategy. There's going to be the interest cost as well, so just you have to factor that in, of course, based on up and down interest costs over this could be for decades, the strategy, and then the guarantee fee cost as well. You have to factor that in and make sure the client's aware of like how much that could grow to depending on, again, the outstanding balance itself. Some considerations. So you could use the corporately owned whole life policy to borrow against personally, but it also comes down to the amount you're actually looking to leverage. And what I mean by that is if you're taking maybe more of like a nominal amount, like perhaps $40,000 a year, it may be more appropriate to just borrow the 40K to the corporation and then just pay yourself a dividend or salary with that out of the corporation. This way you're avoiding the strategy in general, you're not having to pay the guarantee fee, you're avoiding any sort of shareholder taxable implications in the future, taxable benefit that could come back to the shareholder if this wasn't done correctly. It just might not be enough to do this. And especially if it's less than 40K, I would at least look at both options. If it's a lot higher, 250 a year, 2.5 million a year, like just a very, very high number, then it certainly may be worth looking at the CIRP, even though you're factoring the guarantee fees and the interest costs and outstanding loan balance, etc. It certainly mathematically might be worth it the more they kind of take out. If you haven't read this is a fantastic, fantastic document by Sun Life for advisors, but also to share with accountants and lawyers. It's written extremely well. If you don't have it, I guess I could send it to Corey and he can share it with everybody as well. But this will a lot of accountants are gonna will tend to push back on this. They've never heard of it, and they're of course risk adverse. So any strategy where you're kind of leveraging corporate assets for basically tax-free personal income, they're going to get weary of. And this is written very well to explain how this works and all the risks associated with it. So again, we can send that out. So for me, that's it for me, Weston. I'll pass it off to you. Let me just stop sharing for a second here.
Thanks, Mike. I'll pull up on my side. There we go. All right. So everybody can see it okay. So
So I'm going to talk about what's called an IFA or an immediate financing arrangement. This shares a lot of similarities with the CIRP or the IRP that Mike just talked about, but this is done earlier on. And there's different reasons for potentially doing this. Um, I'm not, Mike covered a lot of the things about making sure that, it's set up properly, it's accounted for properly. You have the accounting and the accountant and potentially lawyers involved and so forth to make sure it's all set up and running properly. So I won't get too far into that, but those are all very important elements that we need to make sure are handled when you are presenting these and implementing these types of strategies. So when we look at the strategy, just a quick disclaimer, all the good stuff. Just further on what Mike was talking about, these are strategies that have been well established and they've been around for a while. And, there's a number of different companies, large institutions that are involved in implementing these, not just on the insurance side, but also from the lending side, National Bank, BMO, Scotia, Manulife Bank, etc. Those are some of the big players. There are some other ones involved in well, but those are kind of the bigger names that we probably recognize. So just to lend some credibility to the fact that these are well-established strategies. So with IFAs, and similar to Mike talked mostly on the corporate side. I'll talk a little bit about on both sides. You can do these strategies both personally or corporately. So in the case of a personal IFA, why would you want to do these? One, it allows the owner to have a significant life insurance policy while maintaining cash flow for other goals. With the IFA, they're using the bank's money to essentially fund the bulk of the policy. They're tax efficient through deductible loan interest and estate planning. Again, that comes down to making sure that they're properly accounted for, and when they're used appropriately, the interest on the loans can be tax deductible. You can avoid having to liquidate assets and preserve your wealth. They allow for tax-free wealth transfer, as we've talked about before, and we'll talk about in later strategies, just through using life insurance. It can be used in retirement planning, as Mike just talked about here with the CIRP. There's elements that play into that. And obviously, there's life insurance involved, so it protects the family in the event that the person passes away. So how does this work in the case of a personal immediate financing arrangement? So if we look at a female client, she's 50, relatively healthy, non-smoker, and let's say she's a high income earner in Ontario, and she has we've identified that the life insurance policy she needs to get, that she wants to get, is going to have a premium of about $250,000 per year. So she pays that annual premium to buy that life insurance policy. Now, where it starts to get interesting is that because of the cash value that's built from that life insurance policy, the banks will lend against that, as we've discussed. So in this case, the bank will then we assign the CSV as collateral for the bank, and then the bank will lend that $250,000 back to the shareholder. So again, very similar setup to what's going on with the CIRP, simply that it comes down to the timing of when we're doing this particular strategy. So in this case, we're doing it, you can do it at almost any time, but in this particular case, we're doing it almost immediately for the client. So just looking at the numbers here, and how this would look over a 10-year basis, just using a snapshot, you've got client's age and years here, yearly out-of-pocket summary. So we set this policy up to run for 10 years. So the 250 a year for 10 years. Here's the cash values of each year, and how they grow, starting at 215 and ending at just shy of 3 million over 10 years, the death benefit payout. And then we start looking at the loan amount. Well, this is what the bank is paying back to the shareholder on an annual basis. So it starts at 250, and then they do it each year up to the point that gets to 2.5 million. For the first 5 years, use 6.5% as their interest rate, then dropped it to 6 for the following 5 years. There's our total interest cost on an annual basis. So there is you have to be aware of the cash flow needs required to make these policies work, because the interest still has to be serviced throughout this time frame. And then you've got the cumulative interest cost in the next column. This is what the total cost would be. However, cost of borrowing rate after deductibility, if they're set up properly and that loan from the bank to the individual is tax deductible, the rate drops to the effective rate drops to 2.94 in the first few years, and then 2.82 the following 5 years. And then, so what's the actual dollar coming out of it? Cost of borrowing after deductibility drops a little more than half. So the cost, goes from, cumulative costs there on the when we looked, if the loan is not tax deductible, was over 800,000. Cumulative cost of borrowing in the last column at the very end is under 400,000. So the tax deductibility can definitely make a big difference as to if this type of strategy makes sense for the client. So, at the end of the day, where does this leave the client? So 10 years out, the cost of doing this cumulative cost is 392,000, but they have a cash value worth 2.9 million and a total death benefit of 8.5 million. So two very significant numbers there for a rather marginal cost to them at the end of the day from a net standpoint. So the question becomes, okay, great, we've got this we've set this nice life insurance policy and so forth, but we also have this significant loan. What do we do about that? Well, one you can always do is you could redeem the cash value and repay the loan. You've got almost $3 million of cash value. The total loan is sitting at about 2.5 million. If you redeemed out the cash value, there would be some taxation on that because there is some ACB consequences to realize, but there is significant enough cash there to pay off the loan if you want. Now, that's not the ideal solution, but it is an option. The other option is you hold the policy till death, and you use the death benefit to repay the loan with the balance to the estate and or surviving shareholders. So in this case, 10 years in, let's say the person at 60 for whatever reason, does pass away. There is $8.5 million that gets paid out. 2.5 goes to pay off the loan, and then the balance would go to that person's beneficiaries. Now, the thing is again, at the end of this 10 years, we still have this loan in place. Now, assuming that the client is not going to continue to borrow more against this policy, they're just going to put it in offset and so forth. Both the cash value and the death benefit are going to continue to grow, but the loan amount will stay the same. So there's a couple things here. If you're going to just service the loan, you could service the loan amount on an annual basis, assuming you have sufficient income and so forth, and tax deductibility. It would cost about $70,000 a year just to service that. The benefit being is that it wouldn't grind down that death benefit in the future. Some people like that, some people don't. It depends upon their goals at the end of the day and what they're trying to achieve. The other option is that you can start to capitalize that loan interest to minimize or eliminate future interest costs. Again, when these policies are properly set up, the cash value and the death benefit should be growing fast enough to offset or more than accommodate the growth in the interest. So if you start to capitalize that interest each year, so that 70,50 actually gets added to that loan amount of 2.5 million, there is still sufficient cash value to manage that from a growth standpoint each year. So you're able to capitalize that on an ongoing basis. Now, again, these are long-term strategies. That time frame, as Mike says, you do have to look out to the future. You do have to make sure that you're looking at these appropriately. Typically, it's between years 10 and 15. And again, it depends on how the policy is structured, which companies you're using, dividend growth, and so forth, is when this becomes a viable option, being able to capitalize that loan. If that is the route that the client would prefer to take going forward and so forth. So those are things that you need to keep in mind as we look forward with putting these strategies in place. Corporate IFAs. So what these allow the business owner to do is similar structure, but we're just doing them through the corporation here now. It includes benefits of the personal IFA, so you maintain cash for business growth and or investment. Again, the bulk of the money that is not going just to the insurance company, you're basically just paying the servicing of the loan. Tax efficiency, again, when it's done properly, the loan can be tax deductible, as well as the net cost of pure insurance of the policies are also potentially tax deductible when properly accounted for. Avoid liquidating corporate assets, preserve corporate wealth. Tax-free generational wealth transfers are viable through this strategy, and again, protecting the family. The other pieces of you can offset future capital gains tax in succession planning. Again, when a person goes to sell their corporation or transition, there can be significant taxation issues. This can create, a very significant death benefit to allow to offset a portion or all of it. You can be set up for employee retention or employee ownership. Again, there's ways of using this strategy that you can use the cash value as a bit of a golden handcuffs for employees and so forth to have capital to buy out shares of the corporation in the future. That's a little beyond the scope of this, what we're going to talk about today, but it is a viable strategy that we've seen used in the past. And you, again, if depending how aggressive the client wants to be and understands the risks involved, you can immediately access tax-free retained earnings inside the corporation when set up properly. So when we look at these, you protect the corporate cash flow using bank funds, you create tax-free shareholder loans, tax-free cash value over time, and death benefit pays the principal of loan from the lender. So it's a great system to retain employees or transfer ownership. So if we look at this and see how it's set up, we've got a business owner, they have a corporation, and there's a need for life insurance. This could be any number of reasons, buy-sell agreements, all kinds of different reasons, but there's a need for life insurance. And let's say in this case, we've determined that they need about a $4 million, almost $5 million life insurance policy, and that premium is $250,000. Here's on a 48-year-old male in the top marginal tax rate in Saskatchewan. His cash value would be about $230,000. Death benefit is almost 4.8, and there's his CDA on that first year, 4.5. So as we talked about, banks are willing to lend against that cash value. So when we use a CSV for collateral, the bank in this particular structure would simply lend that money back to the corporation, and then the corporation can just run this over and over and again for a number of years, so that it has minimal impact on their cash flow, but it does give them lots of protection in the case of death benefit and CDA in this regards. So, however, there is a way that we can be a little more aggressive with this if clients are also looking for a tax angle to make this more appealing. We can instead the bank will lend to the business owner personally, as opposed to lending directly to the corporation. And then in this case, the business owner then lends that money back into the corporation for business purposes, and that creates a $250,000 shareholder loan. So if you're familiar with the rules, taxation rules, is when a business owner lends money into the corporation, it creates a shareholder loan, which means that amount of money can come back tax-free to the shareholder, to that shareholder. So when we do this on an ongoing basis, if we look at 5 years down the road, there's your values on the right-hand side. And then there's your shareholder loan by year 5. Now, again, you can use some of it, all of it, or hold it till later. But at that point, you've generated $1.25 million worth of tax-free shareholder loans. By year 10, you've got almost $3 million of cash value. You've got $9.5 million of death benefit, $7.2 million of CDA, and you've got $2.5 million of tax-free shareholder loans, which are pretty impressive. So the question is, again, what does this cost, right? Okay, great. So if we look at this interest cost over 10 years, I used a little bit higher different rates on this one. This is a little bit of an older illustration that we did with clients, but 6.7 for the first 3 years, 6.25 thereafter. Interest cost on this over 10 years was about $860,000. Interest deductions on this, again, when it's properly set up and properly accounted for, were about $337,000. And then you had a cash surplus of $405,000. When I'm talking about the cash surplus is that we've got a loan, $250,000 each year for 10 years, $2.5 million, but the cash value is at $2.9 million. So there's $405,000 over and above what's currently owed. The net cost, when it's taking the interest cost subtraction, the cost surplus, is $460,000. If you, again, set it properly and you want to use the interest deductibility, that drops even further, the $337,000. The net cost is down to $68,000 total. Now, again, you have to keep in mind cash flow. You need to make sure the client has sufficient cash flow to be able to service the loan and so forth. but it's pretty appealing from that standpoint of having, significant cash value, death benefit, and CDA, shareholder loan, and for a very nominal cost at the end of the day. What are your tax savings in Saskatchewan? For for $250,000, being able as a shareholder loan, the tax-free amount of that is $103,000. Over 5 years, it's over 560,000. In over 10 years, it's over $1 million in tax savings that they would have had, but with those shareholder loans. So again, how do we complete the strategy? How do we wind this up at the end of the day? Because we do have a loan outstanding. One, we talked about redeem the cash value and repay the loan. Again, there can be some tax issues around doing that, but it is a possibility to do it that way. Otherwise, you hold the policy to death and use the CDA to repay the loan with the balance to the estate and to the surviving shareholders. Again, they can either choose to service the loan if there's cash flow available to do so and maintain the death benefit amount, or they can capitalize that. And again, depending on the policy, it'll take anywhere from 10 to 15 years typically to get the policy in a position where it's growing sufficiently enough that it can capitalize the interest expense that the outstanding loan creates as well. So what's your tax savings from the IFA in this particular strategy? If you look at it, for each $100,000 of shareholder loans versus paying those out as dividends, depending upon your province, you're in Saskatchewan, it's about $42,000 for each $100,000 you're going to save. Up to BC, where you're going to save almost $49,000 for every $100,000 of dividends you would have paid out. So the tax savings can be quite significant, and in a lot of cases are pretty attractive to business owners. So what's the benefit of doing that? You're accessing cash trapped inside the corporation using the shareholder loans. And then once they can get that money out, they can use that to fund their personal financial plans, pay off any personal debt that they may have, higher interest debt, or they can pursue new investment opportunities if that's what they're looking for. Again, there's money there to offset future capital gains taxes. It's a proven concept with low cash requirements at the end of the day, and it protects your family in the event you pass prematurely. Pros and cons. Pros. We talked a lot about these. I'm not going to go through them in detail. Con side, cash value can take a few years to catch up to the premium amount, right? If a client gets into this type of strategy, any of these lending strategies, and decides within the first 1 to 3, 1 to 5 years, again, depending on the policy, to cash it out or pull out, it's not going to be financially advantageous for them, unfortunately. So they have to realize that this is a longer term strategy. If they're only looking at this on a short term, then this is not the right fit for them. They have to qualify for life insurance to be able to use the strategy. If they're not healthy enough and they don't have a good situation, they may not be able to qualify and may not be able to do that. Now, there are ways around that because in not all cases, they may not have to be the ones that's life insured. If they have other key people or family members, they can be insured. But again, they still have to qualify for life insurance and pass the underwriting. And they also have to qualify for the IFA in order to fund using the bank's money, right? You are using an institution. They are going to go through a lot of the same financial underwriting that you would do for any other kind of financing that they would be looking at. The IFA process itself, how we set up, is simply, we present the strategy to clients. If they like the strategy, we'll complete a personal and/or corporate review as needed, depending upon the type of lending they're trying to do. We then complete a power insurance application for them to make sure that they can actually get the insurance. We then complete the immediate financing application to make sure that they qualify for that. And then only at that point do they need to make the final decision once approvals are obtained. So up until that point, they haven't had to commit to anything. They haven't had to put anything out of pocket, to approve the process. Understanding that business owners and high net worth individuals are usually very busy. We're only looking to really, at the end of the day, use about 4 to 6 of their hours over 2 to 3 months. I don't think that's too much to ask for the significant tax savings you can have here. But again, that's what we're trying to do. So if a client is engaged and wants to see this through, we have gotten these in place in about 2 months for some clients in that regard. So That's the process. Prospective clients, high net worth individuals, and this would apply to both CIRPs, the insured retirement plans, or the IFA strategy. Often it's high net worth individuals or business owners needing permanent life insurance, and they want to maintain cash flow for investment or business growth. They should have a certain level of financial sophistication, and they should be looking at long-term planning. And they need to understand the strategy's complexity and be comfortable with leverage. If they aren't, then A, you're going to be in an uphill battle, and B, you could be again facing a situation in the short term where they, for whatever reason, they don't really understand what they're doing, and then they back out of this strategy, and it leaves a sour taste in everybody's mouth because a lot of work will go into putting this in place, and so forth. So just be very careful with the kind of client you bring forward. Always happy to present it, but there is a delicate balance of making sure that you have the right client in place to implement this strategy. With that, Corey, I'll hand it back to you.
Thank you, Weston. That was a really great presentation. Some really good examples in there. I really like how you went through the content. This strategy is complex, and of course we use more straightforward examples. When you get into the real world, sometimes you find even more complicated situations, especially when you start diving into some clients' corporate structure, different shareholders, different corporations, holdcos, maybe family trusts. So these types of strategies can be a great opportunity when you have the right client, but I would recommend that you loop in with Weston or Michael when you come across these opportunities, because there is a lot to know. There are a lot of things that can kind of throw these strategies a bit off, where you have to change sort of how you're structuring, presenting to adapt to the client situation. And when you have a very large opportunity like this, you want to make sure you bring it home. If it's a client that's the right fit, and this is only one of many options when you get in the door. Maybe you're presenting this, or Weston or Michael is presenting it, and they might not be comfortable with this strategy or the leverage, but they might pull the trigger on one of the other strategies. So it's about helping them understand their options and see what's comfortable for them. Like which strategy is the best fit for them. And it is a long-term strategy, so you want to make sure that it's presented correctly, that everything, the whole process is managed properly, and that's how you get a happy client at the end of the day that understands the strategy they're doing, why they're doing it, and is in it for the long haul. Because you need to be with these types of strategies. You can't do it for 6 months and pull out, or that's going to create a challenge for everybody, and the client will lose out of those. So yeah, it's a great opportunity. I think the ability to leverage like this can also create some flexibility for clients. And when you're doing financial planning, like I have for many clients, sometimes their plan can change suddenly and unexpectedly, or it just changes over time naturally as their career changes, as their businesses change. And having the ability to borrow against part of your assets is a very good opportunity for your clients. It builds a lot of flexibility in for you and your clients. These are some of the bigger strategies around that. But even just having par as an asset class and having the ability to leverage, getting up to the 90% loan to value is a huge opportunity for building flexibility into your clients' financial plans. If they invest in assets through TFSAs, RSPs, they can't leverage. If they do have non-registered, maybe they can, but it kind of ranges from 0 to 70% loan to value. A lot of real estate investors are comfortable with leverage and use leverage. They can typically go up to 80% loan to value, but with a par investment, par as a whole life strategy can go even higher than that. So the banks really see the quality of this asset. It is a great asset class to have in your client's portfolio. And I think it's a huge opportunity. So if anybody has clients that might be a fit for some of these strategies, again, encourage you to reach out. We did add the contact info for Michael and Weston. And thank you everybody for joining us. And thank you, Weston and Michael, for presenting today. Really appreciate it.
Thanks, Corey.
Yeah.